Pier 1 Imports, the trendy home goods store that sold scented candles and wicker baskets to a generation of yuppies, has turned off the lights. The brand that once challenged consumers to look beyond the beige filed for bankruptcy in February 2020 after years of lackluster sales. The company announced in May it was winding down its entire business and selling off its remaining inventory due in part to the coronavirus pandemic. In its heyday, Pier 1 stores were known for their treasure hunt atmosphere and renowned for their colorful home furnishings and distinctive holiday decorations.
They were a unique retailer with unique products, well understood by their customers, and that has thoroughly and completely disappeared.
But times have changed, and the retail landscape in 2020 has been a brutal one. In just the first 6 months of 2020, legacy brands like the long-struggling JCPenney, preppy clothing store J.Crew, and luxury retailer Neiman Marcus have filed for bankruptcy. Pier 1 CEO Robert Reisbach said in court papers that the company was the victim of a perfect storm. But analysts say changing consumer tastes, an influx of new competitors, and several key decisions by management led to the company's downfall. The home goods market is fragmented, competitive, and rapidly changing. And Pier 1's unique blend of products and experience no longer seem to resonate with consumers in a sea of furniture outlets, big box stores, and online retailers.
So retail has changed more dramatically in the last 15 years, 5 years maybe, than even the last 50 or 100 years. The internet is a big part of that, but so too is just the way that we shop, what we're comfortable buying, how we're comfortable buying it. What is interesting about this Pier 1 retail bankruptcy is this is almost more of a classic bankruptcy, where this was a business that was just over time in decline.
So after more than a half century in business, what really led to Pier 1's bankruptcy? And who has the most to gain from Pier 1's fall? Pier 1 Imports got its start in 1962. The first store opened in San Mateo, California, and sold love beads, incense, and beanbag chairs to hippies. Over the years, the company expanded, selling everything from linen sofas and dining room sets to wicker baskets. It also grew rapidly, going from 123 stores in 1970 to more than 1,200 stores at its peak. The business strategy at the beginning was simple: importing exotic home furnishings from Vietnam, Indonesia, and other countries at rock-bottom prices and selling them at a markup. In the early years, Pier 1 was basically the only game in town for somewhat sophisticated yet kitschy home goods. Pier 1 went public in 1970 and saw impressive sales growth in its early years and expanded rapidly in the US and overseas into Australia and Europe.
Going back to that period before things started falling apart, they had a unique understanding of a particular type of product. They had a unique understanding of a particular group of consumers, a particular segment of consumers, and they served it very well.
In the 90s and early 2000s, Pier 1 positioned its price point roughly 20 to 30% below rivals Crate & Barrel, Williams-Sonoma, and Pottery Barn. Shoppers flocked to the store and the stock surged. Shares closed at a high of $523 in December 2003. The company struggled during the housing-led financial crisis of 2007 to 2010, but started to bounce back under the leadership of then CEO Alex Smith.
Here's what we think. We're going through a bumpy patch at the moment, but we have a strategy which we're absolutely confident in. But this major transition, as we move from the hugely successful bricks and mortar business, and as we transition into what we believe is going to be an equally, if not more successful omni-channel business, we know that as we move a little further into this transition and the investors start to see some of the benefits of all the investments we make coming through, we know that our stock's going to start moving again as it did in the past.
But Pier 1 hit a major stumbling block with e-commerce. The company was late to the game and launched Pier1.com in June 2000. According to analysts, the limited product selection didn't showcase the store's unique treasure hunt experience, and building the online business from scratch was an expensive undertaking. The e-commerce portion of the site shut down and was relaunched in July 2012.
Their online retail, was a disaster. They actually closed it down in 2007 before restarting it 5 years later.
When you have a legacy brick and mortar business and you've sort of been able to deal with these amortized costs over time and gotten to a good place of profitability, and then you begin an online business really from scratch, that's a very expensive endeavor. And so after Pier 1 finally did establish an online presence, it started to see profitability significantly erode.
By 2019, only about 30% of Pier 1 sales were generated online, but it wasn't just e-commerce problems that plagued the company. Brick and mortar stores were reeling too. Customers complained that excess merchandise left the stores feeling chaotic and clustered.
And that's really when they started to lose market share. For example, they kept that older customer, but the younger customers, those that were in their 20s or 30s, really gravitated to those other retailers.
And according to experts, many of Pier 1 storefronts were situated in less than desirable locations.
Pier 1 is often saddled with lousy locations. The one in Madison was basically in the same strip mall as a dollar store. Not the kind of environment, that is conducive to being a highly differentiated retailer. It signals the wrong thing. It signals we're a discount player. If you're signaling to your customers we're a discount player, and you don't want to charge them discount prices, you're going to leave them very confused. And they did, of course, leave them very, very confused.
Shifting trends in interior design were problematic for the company as well. By 2015, home furnishing styles moved towards mid-century modern, reminiscent of the TV show Mad Men. Those bright colors that Pier 1 banked on for decades were out, and neutral colors like grays and beige were back in fashion. The U.S. home furnishings market is a $200 billion industry. According to a March 2020 IBIS industry report, the biggest home goods stores in the U.S. were Bed Bath & Beyond, Home Goods, Williams-Sonoma, RH, formerly known as Restoration Hardware, Crate & Barrel, and Pier 1 Imports. The remaining 39% of the market is a mix of small to medium-sized companies. In 2019, Pier 1 was facing competition from every angle and doing what it could to stem the losses. While overall sales at Pier 1 grew from nearly $517 million in 1990 to more than $1.5 billion in 2019, same-store sales had fallen for 3 straight years in 2017, 2018, and 2019. Discount retailers like Home Goods, Marshalls, and At Home were making inroads by offering similar products but at a lower price. To compete, Pier 1 slashed prices.
In the end, they moved down that price-cutting sort of road. And that's clearly a sign of desperation, for sure, as cash got tight. But I also think that is a response to having no idea how to rebuild the uniqueness in this new sea of rivals.
In 2019, 67% of Pier 1 sales came from decorative accessories, such as pillows, ceramics, and candles, and about 33% of sales came from furniture. That was problematic for Pier 1's business model. Retailers generally make more money selling bedroom furniture than hawking pillows. As consumers were becoming less skittish about buying dining room tables and sofas over the internet, online retailers like Wayfair and Amazon began eating into Pier 1's market share as well. In August 2020, online furniture retailer Wayfair announced second quarter sales jumped 84% from a year prior, due in part to stay-at-home orders. Shares surged to $333 on August 19, 2020.
So all of a sudden there's an explosion of competitors.
This is just something that all of retail has had to deal with in a number of categories, frankly, as the world has become more global with its sourcing ability. And so it is easier for other companies and less expensive to bring in product from all over the world, both because of supply chains that have gotten more advanced, but also, frankly, because of how consumers are able to access it.
Big box retailers posed a major threat too. Walmart and Target both have their own home good lines and have partnered with designers like Italian fashion house Missoni and celebrities like Drew Barrymore. And because of their scale, the retail giants are able to offer products cheaper than specialty stores like Pier 1.
So it just adds an extra layer of competitive pressure that's almost impossible for Pier 1 to compete with, at least on a level playing field when you're talking about cost structure.
But despite the explosion of new competitors, analysts say ultimately the reason Pier 1 failed was its inability to recapture their unique spirit and missteps by management that only exacerbated their financial problems.
As things start to get bad, it seems to me they made a bunch of choices that made it worse, not better. They might have been expedient choices in the short run, like closing down their online platform in 2007, or moving into sort of 30% off at Pier 1, discounting kinds of marketing. But these took their problems and made them worse.
Pier 1 filed for bankruptcy in February 2020 and later announced it was winding down its entire business due in part to the coronavirus pandemic. According to July 2020 court documents, Retail E-commerce Ventures plans to purchase Pier 1's online assets and intellectual property for $31 million. While the specialty retailer has a smaller share of the home furnishing industry than some of its rivals, those Pier 1 store closings could be good news for a few retailers. By 2019, Pier 1 had net sales of $1.5 billion, a decrease of 13.7% from the year prior. According to the brokerage firm Telsey Advisory Group, the home goods stores that stand to benefit the most from Pier 1 store closures are the ones with the largest customer and geographic overlap. Since 2018, the biggest beneficiary of Pier 1's lost sales have been retailers that sell mid-price home furnishings like Wayfair, Home Goods, Target, and At Home. Those retailers could profit even more in the future. Location is another key indicator. In March 2019, Pier 1 had 906 stores in all 50 states. About 60% of Home Goods, At Home, and Bed Bath & Beyond stores are within 3 miles of Pier 1. Target has about 35% of its stores within a 3-mile radius. But analysts say that no matter where Pier 1 shoppers end up, it's likely to have little effect on the overall bottom line of major retailers.
What are we talking? A couple $100 million a piece? It's irrelevant. This is not going to change them other than rounding error in their income statements, right?
And even with Pier 1 out of the game, the home goods market remains a crowded place, and that could be great news for consumers.
So in some ways, the retail landscape has never been more competitive and more difficult to succeed in. But on the flip side of that, it's also never been better for the consumer because you have more choice than you've ever had before. You have more options for how you want to get those products than you ever have before. And because of all of those market forces, it's really pushed down prices in many categories, which is great for consumers.